As far as I can tell, crypto margin trading is the same as margin trading stocks or other assets, and the only experience I have with margin is when trading stocks, so I will use that as an example. Margin trading is where you borrow money from the broker in order to be able to enter a much larger position than the available funds that you deposited in the exchange would allow you to. This can allow you to realize larger profits if the trade you enter goes in your favor, but can also allow you to realize larger losses if the trade goes against you. The margin or borrowed funds are a loan, and as such you will be charged interest on that amount, which will vary depending on the broker. The amount of interest you pay will also be determined by how long you hold the position. With most margin accounts stocks, you will get 4-to-1 buying power, so as an example, if you deposit $25,000 cash into a margin account, you would have $100,000 worth of buying power. This may sound great, but if you are not extremely careful, it can be a recipe for disaster. As I said, the only experience I have with margin is when I was trading stocks, and I was very careful not to expose myself to too much risk. I only used margin for day trading, both long and short, but I never held positions overnight. They were always closed out before the market closed. So, as far as the second part of your question, is it a good idea using Binance's upcoming new platform? And by it, I assume you mean margin trading. I would not encourage anyone to use margin unless they already have a lot of experience trading and also a decent amount of success trading. This is where you need to be honest with yourself about just how good you really are, because if you are not and start trading with margin, you can quickly find yourself in a very bad place. Margin trading is quite profitable, but very risky. It is the process whereby you take a speculative position using a loan. For instance, if you want to make a bet that Bitcoin is going to go up in value, you would take out a loan and then use the loan to buy the Bitcoin. That is the difference between ordinary trading and margin trading. You are doing it with somebody else's money generally. If you want to trade on margin, you need to have an account with a broker, but in the case of a cryptocurrency margin, you need only an account connected to particular exchange, which is supporting margin trading. Also, there are some requirements for collateral. Just like in any loan, you can expect interest expenses. Other question: Binance launches tokens, and that is the whole story. Binance doesn't decide the price of the assets, the users do. As is every investment, it is a risk. Binance is not forcing anyone to participate, only providing a safe way to invest, as well as the due diligence required to ensure it is a real project. Nonetheless, some people seem to have trouble accepting responsibility and instead choose to blame anyone and everyone else for their own bad judgment.